Measurement, valuation, and disclosure. Assess short-term items. This study unit discusses two current assets, accounts receivable and inventory. Topics covered in this study unit include accounting for accounts receivable and accounting for inventory. Accounting for accounts receivable, including transactions related to accounts receivable, including the timing of recognition, credit losses, types of factoring, and accounting for inventory, including items to include in the cost of inventory, cost flow assumption methods, calculating cost of goods sold, and ending inventory using different cost flow assumption methods. The effects of inventory errors, the lower of cost or market value, the lower of cost or net realizable value rule. Accounts receivable. Accounts receivable or trade receivables are amounts owed to an entity by its customers resulting from credit sales in the ordinary course of business that are due in customary trade terms. The recording of a receivable, which often coincides with revenue recognition, is consistent with the accrual method of accounting. Allowance for credit losses. The allowance for credit losses is the contra asset that reduces accounts receivable on the entity's balance sheet. This account is used to keep track of management's estimate for the amount of accounts receivable that the entity estimates it will not be able to collect. Credit loss expense. Credit loss expense is the income statement account used to keep track of the expense related to estimating credit losses. Balance sheet presentation receivables should be separated into current and non-current portions. Most of the entities' account receivable are classified as current assets because they are expected to be collected within 1 year or the entity's normal operating cycle. Current accounts receivable are reported in the balance sheet at net realizable value, NRV. Net of allowance or for credit losses, uncollectible accounts, allowance for sales returns, and billing adjustments. Non-current receivables are measured at net present value of future cash flows expected to be collected. Allowance method required under GAAP. The allowance method attempts to match credit loss expense with the related revenue. This method is required under GAAP. As specific accounts receivable are written off, they are charged to the allowance account. Write-offs do not affect the carrying amount of the net accounts receivable balance because the reductions of gross accounts receivable and the allowance are the same. The write-off of the particular account has no effect on expenses. In the balance sheet, the carrying amount of accounts receivable is reported as the net amount expected to be collected. Under the allowance method, the two approaches to calculating the amount charged to credit loss expense of the income statement approach and the balance sheet approach. Income statement approach, percentage of sales. Under the income statement approach, the entity estimates the periodic credit loss expense as a percentage of sales on credit. The ending balance of the allowance for credit losses is determined after the activity in the allowance account is recorded during the period. Balance sheet approach, percentage of receivables. Under this approach, the ending balance of the allowance for credit losses is a percentage of the ending balance of accounts receivable. Credit loss expense reflects the adjustment of the allowance to its correct ending balance. An entity rarely experiences a single rate of uncollectability on all its accounts. For this reason, entities using the balance sheet approach to estimate expected credit losses for accounts receivable generally prepare an aging schedule. Allowance for customers' right of sales return. When a right of return exists, an entity may recognize revenue from a sale of goods at the time of sale only if the amount of future returns can be reliably estimated. A provision must be made for the return of merchandise because of product defects, customer dissatisfactions. To be consistent with the matching principle, recognition of revenue and related expense in the same account period, the revenue from the sales of goods and the expense for the estimated sales returns must be recognized in the same period. An allowance for sales returns should be established. Factoring of an accounts receivable. Factoring is a transfer of receivables to a third party, a factor, who assumes the responsibility of collections. Factoring discounts receivables on a non-recourse notification basis. Thus, payments by the debtors on the transferred assets are made to the factor. If the transferor or the seller surrenders control, the transaction is a sale. The transaction is a sale. If a sale is without recourse, the transferee credit agency assumes the risk and receives the rewards of collection. This sale is final, and the seller has no further liabilities to the transferee. According, the receivables are no longer reported on the seller's financial statements. If a sale is with recourse, the transferor or the seller may be required to make payments to the transferee or to buy back receivables in specified circumstances. In this circumstance, the transfer may not qualify as a sale. The parties account for the transaction as a secured borrowing with a pledge of non-cash collateral. The receivables are still on the seller's financial statements, and it must recognize a liability for the amount of cash received. The main reasons for factoring transactions are: the factor often operates more efficiently than its clients because of the specified the factor often operates more efficiently than its clients because of the specialized nature of its services. An entity or the seller that uses the factor tries to speed up its collections. The entity can eliminate its credit department and accounts receivable staff. Credit losses are eliminated from the financial statements. These reductions in cost can offset the fee charged by the factor. Credit card sales are a common form of factoring. The retailer benefits by prompt receipt of cash and avoidance of bad debts and other costs. In return, the credit card company charges the fee.